So Lemonade just issued their Q1 2024 letter today. I've read through it a few times. I want to give you my analysis, my thoughts. I've updated my Lemonade model. We're going to walk through that, look at some graphs. And this was a really great quarter for Lemonade. Every quarter, I'm just more and more excited for the future. And honestly, part of me hopes, that it's almost like a secret that there's a small group or community of us investors sort of holding and I think understanding and seeing this story play out. And the market as a whole, market as a whole knows nothing about it. Most analysts, I feel like, haven't looked into it very deeply and don't really understand it. I've done kind of a quick 5-minute gloss over look without really understanding. So it's exciting for us that are really thinking deeply about Lemonade, thinking deeply about the thesis, and quarter by quarter seeing this thesis play out for us is really exciting because in my mind, how I think about stocks, how I think about investments is that's the perfect opportunity. If the execution keeps happening and the stock price is staying relatively flat, I mean, we had a bit of a jump after earnings today, and we'll see how that plays out tomorrow and in the weeks ahead. But if the price can stay relatively low, even though they continue to execute and continue to improve, that is the perfect storm for the investor, for the intelligent investor who can think clear-headedly. What you're doing, it's the perfect opportunity then to be accumulating shares that are a better and better risk return ratio on those shares that you're buying. So that's what gets me really excited. And this Q1 only plays into that even further. So let's dive into it. Okay, let's dive into it. So first of all, 794 million IFP. A little bit less than I was thinking. I want to pull up here my side math kind of thing on my Lemonade model. By the way, if you want to join my Patreon, you can get full access to this model and play with it yourselves. But I was thinking 812 million IFP, so I was definitely too high. The guidance they had, if I flip back a quarter, guidance, so this was the previous quarter, was 791 as the high end. So 794, slight beat on the high end of what they're guiding for, but definitely lower than I was thinking they might land. And part of the reason why they're lower, a couple reasons why was this number right here. So they say that in this letter, later on in the letter, they say, hey, of their sales and marketing spend, which was 30 million, we spent 19.8 million on customer acquisition. So 19.8 million, that is a significant amount. It's more than a year ago, 16.3. It's more than the last several quarters, 12.5, 12.6, 13. But it was still not quite as high as I was thinking because they said in at Q4 letter, that the last quarter's letter, that they're expecting to spend about 110 million for the whole year. So I was expecting that would be still a higher amount, maybe more like, I was thinking here, if I go back to here, I was thinking the customer breakdown would be kind of like this in a millions of customers basis over the 4 quarters. So say they spent $110 million in the whole year on customer acquisitions, and they spend, out of that equals 1, all those together. So 22.2% of that is spent in Q1. I was thinking maybe they spent more like 25 million on customer acquisition costs, but they actually only spent more like 20 million. That on top of that, their cost to acquire each customer, so their CAC value, this is how much they're paying on average to get each customer acquired. It was a little bit higher than I was thinking as well. It's 136. I mean, it's well within the range of the last, if you look back over the last few years. And here's a chart of the CAC value or acquisition cost per customer over the last few years. So it's this last quarter, Q1, is well within the range at $136, but the last few quarters, and they've been more renters, more pet sort of focused, it's been even lower, like 110 and even below $100 per customer. But now we're back 136, 137 kind of range. It's closer to where it was, going back a year, 2 years ago. So that spending a little less, spending a little bit more per customer, Of course, maybe your premium per customer is rising as a result of that, but that gets you a little bit lower overall IFP than I was expecting, but still very solid growth and nothing. Still really happy with that. Now the loss ratio is 79% gross loss ratio. I was said in my preview video I'd be surprised if they were I was saying 81% originally gross loss ratio, and I was saying I'd be surprised if they're like even, beyond, if they're lower than say 77, 78% or higher than 83, 84%. I really thought they would be kind of in that window. So that makes sense. 79%. And I might jump around a little bit. And while we're talking about the loss ratio, I just want to scroll down and try to briefly touch on this graph that showed gross loss ratio ex cat, or excluding catastrophic events. And it's a blue line, and it's been relatively flat over the last year, which was a concern for myself, other investors as well. Hey, why is the loss ratio excluding catastrophic events not showing improvement? They're increasing their prices. That should be sort of driving this line down naturally. And now we have this huge nosedive, which I don't quite understand why it's such a huge dive. But one explanation, at least in part, and maybe a large part of the explanation, could be, if you watched my interview with Daniel about a month ago, I asked him about this line. Why is it not improving at that time? And he said a few things, but one of the reasons he said is that how you define a catastrophic event is a little bit finicky, and it can kind of distort the numbers a little bit, because he was just giving off the cuff numbers. But I think he said it's about, to be a catastrophic event, weather event or event, it has to be, I think it was $25 million in damages. So if something meets that threshold, then suddenly, hey, now those damages are a catastrophic event. And then other quarters, if there are $24 million in damages, well, now it's not a catastrophic event. So if you think about it in Q4, maybe there's still damages happening, but they were under that threshold more so for catastrophic events. So then the difference between what your loss ratio just naturally actually is and what you subtract out of it is less. But then maybe in Q1, maybe there's a lot more that would be classified as catastrophic events, just happen to be how the weather is affected and how you're defining each, sort of drawing the line between one weather event and the next. And there's a bigger catastrophic kind of divide there. So when you subtract out those, it shows a huge improvement. Now, maybe this is going to jump back like in Q2. It's hard to say. I do hope we get some more commentary on that and explanation on the earnings call tomorrow, because it is interesting to see such a big improvement, but maybe that's partly at least an explanation that I could offer for that. And then Lemonade includes this nice graph here, which really highlights, hey, we're headed towards profitability. In every way you measure it, we're headed towards profitability. Gross earned premium keeps rising. The losses, overall adjusted EBITDA, keeps decreasing. Net losses keep decreasing. Net loss as a function of gross earned premium keeps trending towards that break-even point or that profitability point. So kind of no matter way you look at it, they're on the right track. That's, if you want to summarize Q1, they're very, very much on the right track, and even improving, even accelerating along that track, as we'll see here in a moment. But this was pretty sweet. Operating expenses are basically flat, 2% year-over-year increase. I think quarter-over-quarter it's a little more of an increase, but not much. Pretty much flat, even though gross profit went 110% year-over-year. Adjusted EBITDA improved 33% year-over-year, and net loss 28% improvement year-over-year. So they're getting closer and closer to profitability, and their operating expenses are basically fixed there. Then they have the section about the loss adjustment expense ratio, or they'll call it the LAE, or loss adjustment expense. And they say that, which is basically, if you're not familiar with that, it's a percentage of it's a portion of your loss ratio that it basically is what are the costs associated with managing your claims process. So people have a claim and maybe you need to investigate the claim, and you have staff that do that, and that's their full-time job, and they're paying out claims and they're checking that the claims are legitimate. And maybe bigger claims or a house they're investigating, and it's a long process, and they're helping the customers along through that process. Maybe smaller products like pet insurance. An insurer might have someone who's checking the paperwork and making sure things line up and are correct. It's all those expenses related to that. So it's a portion of your loss ratio. So it's an LAE, or loss adjustment expense, of 10% is typical of leading insurers with tens of billions in premium, which you think, you scale to tens of billions, you should be quite efficient at sort of having just enough people necessary for this without having too many people, and then people that are kind of time is spent partly idle, partly working. So you should become quite efficient, even they can get to that point of 10%, and maybe if you have a loss ratio that's 75% loss ratio, it means that actually 65% of that loss ratio is covering the claims, and then 10% is being used on top of that, is kind of wasted further administration of just checking and confirming those claims and doing all this kind of other loss adjustment expense work. So it's saying, despite a relatively small size, Lemonade's loss adjustment expense ratio is at 7.6% in Q1 is notably better than the benchmark, showcasing how technology can dramatically drive efficiency even before the benefits of scale kicks in. Indeed, we have nearly halved this ratio in just 2 years. They did talk about this ratio. I think it was at Investors Day. I'm super happy they're talking about it here in this quarter. It was actually on my question list of potential questions to talk to or ask Daniel about in my interview with him, but didn't have enough time in that interview. Even thought about asking it as a say question for this quarter, but I thought it's kind of just coming out of left field then. I don't know if people are going to upvote that or care about that as a say question. So I didn't bother for either of those cases, but I'm really excited to see this detail because it's something I'm thinking about. Because for Lemonade, the loss adjustment expense is like a big part of their secret sauce, because people wonder, they say, okay, Lemonade has the best. If you look at their pet insurance product, for example, they have the best pricing in the market, and they have competitive loss ratios, just good or better than, the next leading insurer for pet insurance in the market. So how can that be? You might say, well, how could you possibly have much significantly better pricing to the customer, but your loss ratios are similar? Well, it's because I'm guessing the loss adjustment expense of other insurers who say are offering pet insurance is probably very high. It's probably much higher than even this 10% figure, because in pet insurance, maybe somebody has a claim every single year. So you need, if every single customer you had a claim, and maybe they pay $50 a month for, or what's pet insurance called? Maybe it's $40 a month for pet insurance, $50, maybe it's less than that, whatever it is. You're buying pet insurance, a customer, and then every single year they're filing a claim, and then you have a staff person who's working on that claim, maybe a portion of a day or days of their time, and figuring out and making sure the claim is legit and issuing funds back to the person. So it's huge opportunity if you're like Lemonade to make as much of that process as automated as possible, which clearly they've done, because their overall loss adjustment expense 7.6, beating that 10% mark, like I said. And this is when Lemonade is mostly renter's pet. They're sort of heavy in those products, which I'm guessing most insurers would really suck. Like, I don't know what the values could be, but I wouldn't be surprised if they're like 40% loss adjustment expense in those categories, but Lemonade's overall is 7.6. So super, super encouraging. And again, that's because renter's pet, the premiums are so low. And then when you do have a claim, it just takes time to administrate that claim. Just the fact there is a claim, even though it's a small claim. But if Lemonade can make that as their cost into that as little as possible, because it's so automated, it's really, really powerful. So that's what we're really seeing here in these numbers. And then they talk about the pet specifically. Hey, the pet cost per claim of the loss adjustment expense was $51. You go back to Q4 of 2021, and now it's $22. And again, I've talked about this many times. I'm just banging the drum here. It feels like a little bit, but this is Lemonade's secret sauce. This is Lemonade's secret sauce. This is how they win, because they completely, this is what people completely overlook, but they completely dominate these markets. They just keep dominating these markets. They're small markets relatively in terms of total premiums that you're collecting, but they dominate these products of renters and pet. And then they upsell these customers. They learn a lot about these customers, who's a great customer, who's not a great customer. And then the great customers, they upsell as much as they can to much higher premium products to those customers over their lifetime. So that's the whole thesis in a nutshell. But really, really awesome to see them actually giving really detailed numbers here. And then again, we haven't even got to, man, I'm getting so excited here. We haven't even talked about the cash flow, break even, and acceleration and beyond. So previously we indicated our expectation that net cash flow break even would occur during the first half of 2025. Pleased to note that our expectations have improved due to sustained strength in our underlying unit economics, impact of technology on various expense categories, and working capital benefits of reinsurance and structure. So we expect net cash flow break even, therefore accelerated to year-end 2024. So by Q1 of next year, 12 months from now, we'll be getting a letter that's like, hey, cash flow positive. So we very, very exciting. Expect to be generating positive net flow cash flow on a consistent basis. So I feel like this sort of rough target of when they're going to be cash flow break even just keeps accelerating and improving. So now I think it was even later out before that, if I remember right. And then it was the first half of 2025. And now it's the end of this year. It makes me even wonder, like, is it over the next couple quarters, is he going to accelerate even sooner? And like end of Q3 will be almost break even. Q4, it wouldn't surprise me. So, I've said in other videos, I really feel like Lemonade is just like a rocket ship sitting on the pad, and at some time it's just going to suddenly take off. That's at least my that's my thinking. At some point in time, not sure when that is. Might be this year, could be next year, but seeing them accelerate this improvement makes me wonder, hey, it might come sooner than a lot of people are expecting. Now, scrolling down into the guidance area of the letter at the very, very bottom, there was some minor improvements. This is the previous quarter's letter. So for full year, they're saying $942 million premium, and now they're saying $944. So just slight improvement. Adjusted EBITDA saying $151 loss for the full year versus $155 a year ago. So some slight improvements there, but again, and next quarter they're thinking, $839, $841. I haven't really looked at this closely with my model yet, but an adjusted EBITDA of 47 to 49. I'm going to guess, again, they're probably going to beat all of these numbers. Just how much will they beat them is really more the question. Okay, flipping over to my model, I want to point out a few things. I have a few graphs here around lifetime value. So I'm estimating the lifetime value of each quarter's customers. So for LTV, this should be in dollars. I'll have to fix that up here. But lifetime value, just sort of strictly, and I'll show you how I calculate this in a second, but it's about $500 of lifetime value per customer in the Q1 that we just had, which again was over 500 in Q4, and then was always been less than that previously. And if you look at lifetime value to customer acquisition cost based on that, $130 some cost per customer that we talked about earlier, you're at about a 3.8 ratio, was 4.7 previous quarter, 4.2. So in that range, and this is actually quite conservative, I would say. This LTV number of 500 and some dollars, or LTV to CAC of 3.8, because here's how I'm calculating that. I'm flipping over to here. I'm saying, hey, if you think about this cohort of customers, they pay one customer, or per customer pays $379 a year, but then the annual dollar retention's 88%. So every year, 1 minus 88% is turned away, or 88% is what's left, and then 1 minus the loss ratio, in this case, I'm saying 79%, this quarter's loss ratio is how much sort of gross profit is left over. And I'm taking 4% for the time value of money just in this case, and summing up the present value of that from now until infinity. And that gets you that $517 of lifetime value. But really, this 79%, that's assuming that, hey, every quarter for the rest of time, this cohort of customers that's coming in the door is always going to have a 79% loss ratio. But we saw at Lemonade Investor Day, if I flip over to that presentation, they had predicted cohort lifetime loss ratios in a previous quarter. I think it was Q3. They even showed an updated version of this graph. But they're showing like, hey, they think this quarter of Q3 2022, it's going to be like 61% lifetime loss ratio, or 68. These are predictions, but they're saying for the whole lifetime of a cohort of customers, it might be more like 60% or low 60% range, or even mid 60s is significant, or even mid 70s is significant, still better than the value we were just showing here of 79%. So say that's why this LTV of 517, or LTV to CAC, of 3.8 or whatever the value works out to, if you divided this by I think it's about $135 per customer, and you just compute that real quick. You divide that LTV by CAC, now you get that ratio of 3.8, right? But if say it wasn't 79%, but say it was 70%, say the average loss ratio for this cohort over their whole lifetime is 70%. We'll just compute that real quick. Then you're getting almost like 5.5 LTV to CAC. This was one part of my interview with Daniel I tried to touch on. It's like, I think the numbers are gonna get nutty, because maybe you take them at their word. Maybe it's actually 60%, because the reason is because customers up front maybe have more claims. Some customers churn. They get rid of some of the worst customers in a group, if you're thinking about a whole group or cohort. And then over time, the best customers stay, and maybe some of those customers actually later years, their loss ratio for those customers is 40%, but then the overall mix average over the whole lifetime is maybe 60% or 70% or whatever it is. But say it's 60% loss ratio, compute that again. Well, then you're getting an LTV to CAC of over 7. So the numbers get really nutty really fast. I flip back to my model here, and my LTV to CAC, I'm showing 3.8 kind of for that quarter, but that's very rudimentary because it's only using that quarter's loss ratio, which of course can fluctuate completely quarter by quarter and would change over the lifetime of that cohort. If you look at LTV to CAC on a trailing 12-month basis, it helps smooth it out a little bit. You can see the trend is improving, and I think will just continue to improve as they generate more LTV for a similar amount of CAC that they're spending on the customers they're getting. And then why are they getting more LTV? Well, because they're upselling these customers. That's the secret sauce of Lemonade. They get the customers cheap, and then they're upselling them over time. And this could go really crazy. I really think Lemonade could go crazy over once car is totally checked in by the end of this year, early next year. Car and home, as Daniel kind of indicated in my interview with him. I think it was sort of, if I'm remembering what he said exactly correctly, sort of end of this year, beginning of next year, he expected, on the whole, for the most part, the pricing of auto or home, or of car, and home insurance, those two products, key products, would be more in line with where they would want to be to sort of more aggressively grow those products. So really, really, really significant, that LTV, and I think I'm LTV to CAC, and I think I'm being super conservative here when I'm showing still it's 3.5, which is really solid value, but I think arguably could say it's actually much higher. If we look at a graph of adjusted EBITDA, you can see that it's a little bit lumpy. It's continuing this upwards positive trend, less and less losses each quarter. Last quarter had really significantly low adjusted EBITDA, and this quarter was a little bit higher, but if you look at it on a trailing 12-month basis, smooth it out a little bit, definitely continuing in the same positive direction. Similar to that graph, the Lemonade share adjusted EBITDA per gross earned premium, you can see we're still headed towards that profitability mark, somewhere probably next year point if you follow that same trend line. Customer churn is just barely any improvement in that, sort of flat at 17%. So customer churn, which is, I mean, yeah, if we go back a few years ago, this was all we were talking about as Lemonade investors, was how churn was probably too high, 30% to mid-30s, I was calculating, and now it's continued to track down. I think we might even see a little bit, this either steady out here or a little bit further improvement as more customers can bundle their products with, not just their pet insurance, but also get their pet insurance, their car insurance, their home insurance, bundle some of those things together, and then be locked in, and less chance they're kind of churning. The churn was really high back in the day, and still kind of could be even partly accounted for because they have a lot of renters insurers, and renters are more likely to move more often, and maybe they move to a different place and they don't need the policy anymore, and then maybe later on they do, so they come back. So there's a lot of that swapping around within there. If we look at how much in-force premium they're gaining for the amount of customer acquisition spend they're spending, you're getting about a 3.51 ratio last quarter. And management has said in the past that, hey, the LTV, lifetime value of a customer, is kind of equal to their initial premium. So, if customers $350 in premium a year, maybe they're worth that roughly over the lifespan of their year. But I think the LTV discussion I had earlier could get us a little bit closer than just simply saying, hey, IFP gained, initial IFP is equal to LTV. But it's interesting to see they're still very, very solid, still higher than it really ever was over the last year. If we look at a graph of combined ratio, we're at about 132%, loss ratio is 79%, and then expense ratio, total expenses as a percentage of gross earned premium, is 53%. So it's been kind of flat the last over the last quarter over quarter here, but I think we'll continue to see this slowly trend down as the loss ratio improves, expenses continue to improve, especially as a percentage of gross earned premium as they continue to grow the top line. And then a couple graphs here related to amount of customers per employee. So this used to be super high when they were basically all just renters, like one line. I think as they expand to more and more product lines, they're kind of expanding, growing, and trimming back your head count, figuring out how much staff you need. So you get a little bit less efficient, and then they've kept increasing that efficiency. And I think that will just keep scaling, especially as they find other ways to become more and more efficient. And then if you look at in-force premiums, the amount of premium you're carrying per employee, this also continues to improve. And again, we'll see that same trend just really carry up off the page if you fast forwarded a few years. So yeah, overall, really excited for this quarter. And I just want to say, can we just keep this as a group just keep it on the down low, because that's truly how I feel. I feel like it's inevitable. Maybe I'm wrong. Maybe I'm missing something. Nothing on this channel is investment advice, but I really feel like the rocket ship, it's just a matter of time before things become glaringly obvious to the market that, hey, this is a company that's going to be profitable. The profit's going to keep growing. They can grow 20 to 40% a year in their top line, and probably in that or higher in their profits for a significant amount of time. And then the market is going to go nuts and that rocket ship will take off. But until we get to that point, let's just keep it on the down low so that everyone, if you're invested in this company, if you're as hardcore as me following this company, then you have as much opportunity to buy as many shares as cheaply, as ridiculously low priced as you possibly want to. Again, nothing on this channel is personal financial advice, but those are my thoughts on the stock price as a whole versus the long-term potential of the stock price. Really excited for the call tomorrow. I just want to mention a couple things about that. I hope we do get some discussion here. I wrote some stuff on Twitter earlier. Hope we get discussion from management on this on this change. What's going on there? Can they give us some more color on that? I'd love to hear about that. And then also, I hope we get some more. This tweet here said, hey, I pointed out, I got to zoom in on that picture. 19.8 million was spent this quarter versus 16.3 last quarter. And so 19.8 versus 16.3, even though they said, hey, they're going to do 110 million overall spend. So I'm thinking, yeah, why isn't it higher? Why aren't they more like that $25 million expenditure mark that I was thinking? Be interesting to hear kind of, what's their sort of growth plans for the year, if they're still on track. A couple people chimed in here. Joseph had said he was thinking maybe it's just because it's been a lot backloaded in later in the year because they're still waiting for price increases for car and home and trying to model those things out. So they're going to wait. And then once those price increases are kind of kicking in, they're going to be pushing harder in the second half of this year, which I definitely buy that. I could really see that. Sebastian also said, totally normal. They ramp up marketing spend this summer because it's moving season, ads are less expensive. That is true. Marketing is that Q3 is primarily when they get them by far the most customer growth. But if you look at last year, they actually dropped their expenditure through those quarters. So it's hard to say if that will happen again or exactly, kind of the what the plan will be. But it'd be, I know what he's saying, but it'd be great to get some more color on sort of that overall strategy there. But we'll stay tuned for the call, and I will see you in my next video. Thank you so much. Let me know what you think of Q1. I'd love to hear your thoughts. Send me a message. Let us know, and I'll know in the comments down below. And yeah, thank you so much for watching. Remember, it's in the bag.